the market does this 65% of the time. This is a fact. I really want you to listen to this video till the end because it's really valuable information. If used correctly, you can actually make consistent profit in the long run with this strategy. Now, I'm sure a lot of people know this, but not a lot of people use it. So please bear with me. I'm going to try my best to explain this as much as possible. So when I say the market does this 65% of the time, I mean the S&P 500 index. What is the S&P 500? It's basically the index that tracks the top 500 stocks in America. So it's basically the general market. So here's what I want to show you. So I'm going to go to historical data. Okay, historical data on Yahoo Finance. I'm going to choose everything, max. So I'm going to go as far back as 1927 just to show you how much data I'm collecting for this conclusion, where 65% of the time the market does this. So from 1927 to March 19, 2020, I'm going to choose daily prices. I'm going to click apply, and then I'm going to download data. I'm going to open the Excel spreadsheet. I'm going to remove open, high, low. I'm going to keep close only. All right, so here I've got all the dates and all the close of the S&P 500 index since 1927. So here's what I'm going to do now. I'm going to compare price on day one versus 30 days later since 1927. So here's what I'm going to do. I'm going to take this value here divided by the value 30 days ago. Then I'm going to subtract 1 from it. Basically, I just want to see by how much did the price move 30 days later. So as you can see in this first case here, 30 days later, the stock dropped by 1%. And I'm going to round it to 2 decimals. It's going to look better if I round it to 2 decimals. All right, so you can see here that in this case, the stock dropped 30 days later. Now I'm going to extend the formula. So you see here, I'm comparing B22 to B2. In this one, I'm comparing B23 to B3. So I'm comparing this one to this one. So I'm basically comparing the price of the S&P 500 on a particular day versus 30 days later. What happens 30 days later, regardless of the day that you look at the price of the S&P 500. So now I've extended the formula all the way to the bottom, so all the way till March 2020. I'm going to copy it, open a different sheet. I'm going to paste in values only. I'm going to call it change in 30 days. And then the column next to it, I'm going to call it occurrences. So basically, I'm going to count the number of times the S&P 500 dropped 1% 30 days later, or stayed the same 30 days later, or moved up 1% 30 days later, or dropped 3% 30 days later. So I'm just counting the number of times these percentages happened 30 days later. So simple count if function. So now, of course, as you can see, some of them repeat themselves because I've got negative 1% more than once. So it's showing me 1800 times, 3 times just over here. So basically what this is saying is that the S&P 500, if you look at it at day 1, on day 31, it dropped 1%. 1800 times in the past 100 years. So I'm gonna paste these values as values because right now they're formulas, and then I'm gonna remove the duplicates. All right, so now I've got it dropped 1% 1800 times. It moved 5% 30 days later 1100 times. It moved 4% 1700 times. It moved up 3% 2100 times. I'm just gonna sort it by largest to smallest for the change in 30 days. So right now it's saying that in the past 100 years, the S&P 500 traded 62% higher 30 days later, only one time. It traded 61% higher 2 days later. It traded 30% higher 4 days later. It traded at the same price 30 days later 2100 times, okay? So now I'm just going to, in this column here, just going to look at the percentage of times this occurred, okay? So basically I'm just going to take this divided by the total occurrences. So the total occurrences is 23,000 occurrences. So I'm comparing 23,000 different 30-day periods. Day 1 to day 30, day 1 to day 31, day 2 to day 32, day 3 to day 33. Comparing what happens to the S&P 500 30 days later. So this is 23,000 occurrences. So I'm just going to look at the percentage of each occurrence. So simply just going to do this here, divided by the sum of the occurrences. I'm going to put this in percentage. And add 2 decimals. And then I'm going to extend the formula. So you can see here that the total of this column gives me 100%. As you can see at the bottom here, 100%. So that makes sense. All right, so where does this 65% come from that I keep talking about? All right, so now I want to see what happens. How many times does it stay at the same price or higher 30 days later? Okay, how many times does it stay at the same price that it's trading at on day 1 or higher 30 days later? So if I highlight all these percentages here, I get 64.17%. All right, so just to keep things simple, I'm going to say 65%. So 65% of the time, the S&P 500 will trade at the same price or higher 30 days later. This is a fact. This is stats based on 100 years of data, or 23,000 occurrences. 65% of the time it's going to trade above its current price or higher 30 days later. Now look at this one. If we highlight starting from minus 1%, it gives me 72%. So what does that mean? So that means that 72% of the time, the S&P 500, 30 days later, will be trading either 1% lower or higher or above that. So it can drop a little bit or trade above all that 72% of the time. What if we go to negative 2%? I get 78% of the time, an even higher probability. What if I go to 3% drop? So it gives me 84%. So what that's saying is that on day one, the S&P 500 has an 84% chance that 30 days later, it is not trading below 3% of that price. It is either trading at 3% lower or higher. It's got an 84% chance of doing that. And if we go to 5%, so what does that mean? I get 91%. So that means that if I look at S&P 500 on day one, 30 days later, so on day 31, it's got a 91% chance of trading or not trading. It's got a 91% chance of not trading lower than 5% of its price on day one. So that means it's got a 91% chance of trading either 5% lower or higher. So that's a high probability. That's an edge. That has to be valuable information. How can you make money from this information? What is a trade that allows you to take advantage of this statistic? So if we know that 65% of the time, the S&P 500 is trading above its current price 30 days later. Does that mean that we can... All right, so instead of talking about the S&P 500, I'm just going to talk about the SPY, which is the exact same thing. The SPY is an ETF that tracks the S&P 500 index, but because it's tradable, it's just easier to talk about, and it's usually the ETF that I use to make this trade. All right, so if I'm just going to click on the chart here, pick 1 month. All right, so we know, for example, December 26th, SPY is trading at 322. We know that there's a 65% chance that it's going to be 30 days later, it's going to be trading either at 322 or higher. And as you could see, 30 days later, it's trading at 323. But during the month, it was trading even higher. But I'm comparing 30 days later. 30 days later, it's trading at 323. So in fact, it was trading higher than its current market price on day one. So what's the trade that allows you to make money from this? Can you just buy the S&P 500 on day one and then sell it 30 days later, knowing that you have a 65% chance of selling it higher? Not necessarily, because you've got a 65% chance of selling it higher, yes, but you don't know how much higher. It could be at exactly the same price. It could be 1% higher. It could be 2% higher. And if you do that on day two might fall in the probability where 35% of the time it's trading below. So you might win 2% on the day one trade, but you might lose 5% on the day two trade, because it doesn't always trade above its current market price 30 days later. It trades at 65% of the time. So what is the trade that allows me to take advantage of this high probability? Well, the trade that I'm going to talk about is an option strategy trade. It's called the put credit spread. It doesn't involve stock. So I've got a video explaining what the put credit spread is. I'll link it below, but if you also want to watch other videos, you could simply just go YouTube put credit spread and then look up option alpha videos or tasty trade videos. So these two really explain it pretty well. So it's an option strategy that doesn't involve stock, and it's called a put credit spread. All you do is you sell a put option with a strike of, you sell a put option with an expiration 30 days later, and you buy a put option with the same expiration 30 days later. So for example, if the SPY is trading at 238 right now, I could sell a put option lower than 238 and then buy a put option that's even lower for protection, creating a credit spread, collect money, and I keep that money if come 30 days, SPY is trading above that first put option that I sold. So right now, because the market is crashing like crazy, volatility is high, that put option that I can sell, I can actually go even further out. It doesn't have to be close to 238. I can go even further. For example, if I use my brokerage account here, Questrade, and I pick 30 days out, the closest thing I've got to 30 days is April 20th, which is 31 days. That's fine. And I'm doing a put credit spread. It's also called a vertical put. So if I go 30 points away, so 239 minus 30 is 209, so let's say 210. So let's say 210 is the put option that I'm going to sell, and then 205 is the put option that I'm going to buy. So by doing that, I sell for and collect $6.50, but I buy for $5.70 about. So I can collect about anywhere between 82 cents and $1.12 for this trade. For opening this trade, I collect, let's say, 90 cents. So since the contract is 100 shares, so it's actually $90 if I do one contract. Okay. My risk for this trade, though, the max I can lose is the difference between the spreads. So 210 minus 205, so $5 minus what I collected. So let's say I was able to collect $1 just to keep things simple. So I collect $1 and I lose max. My max loss is $4. But to lose $4, the SPY needs to be trading below 205 come April 20th. So the probability is very small. We just saw that. We said that we have a 64% chance of being above the current market price in 30 days. But in my example here, I'm choosing 210 as the put option that I would sell. 210 divided by 238 is 88%. So I'm actually going 12% lower than 238. So 12% lower is right over here. And that tells me that on average, I've got a 98% chance. That in 30 days, the market price will be trading above 210. So this really isn't complicated. This is probabilities based on almost 100 years of data. So let me give you an example. I want you to look at this line over here. SPY April 17, 195, 190. So this is a put credit spread that I sold on the SPY March 16. I collected $1 to sell this put spread. My risk, of course, is the difference between the two strikes. So $5 minus the $1 that I collected. So my max risk is $4. I did this March 16. So let's look at what the SPY was trading at March 16. So March 16, SPY was trading at 239.85. So when the SPY was trading at 239.85, I didn't sell a put spread at 239. I sold a put spread at 190. I sold a put spread at 195. So I gave myself 45 points to the downside for me to win on this trade. So for me to win on this trade, I need by April 17, which is the expiration of this option contract, I need the SPY to be trading above 195. But in reality, I don't even have to wait till April 17. I can actually close the trade for a profit earlier, as long of course as when I sold the put credit spread on the SPY, it was trading at 239. So as long as the SPY moves up and time goes by, I can actually close the trade for less. So today, you can see over here, I closed it for 50 cents. So March 20th. So 4 days later, I was able to close the trade for 50%. So I don't have to wait till expiration. As long as the underlying stock, which in this case is a SPY, moves in the direction that I want, plus volatility drops. And of course, volatility is going to drop because the market is going up. So volatility drops in that case. So that's why I was able to close it for 50 cents. I sold it for $1. I made 50% of my premium in 40 days instead of waiting the full 30 days. So that was a $50 profit on this put spread while giving myself a lot of room to the downside. And now you might say risking $4 is a lot just to make $50 or $100. But the thing is, I won't accept max loss. There's ways to manage it. Now that's a different video on its own, but as the SPY is dropping, let's say I did this trade March 16, SPY's at 239, I collect $1. My short put, so the put option that I sold was at 195. Let's say the next day the SPY is trading at 230, 225, 220. I'm not going to do anything. My 190 is still safe and I still have time. Or my 195 short put is still safe. But as soon as the SPY drops below 195, I'm going to take action. I'm going to sell a call spread to reduce my max loss. So a call spread is like a put spread, but on the other side. So basically you make money if the stock does not go above a certain price by a certain date. So the way that I would reduce max loss to avoid losing $4 is if the SPY drops below my short put of 195, I'm going to start selling a call spread maybe at 200, 205, 210. So now I've got a limit. Now I've got a limit on the downside and I've got a limit on the upper side. I'll collect whatever credit I collect on the call side. Since the SPY cannot be in two different places at one time, it's either going to be below 195 or it's going to be above 200 or 205 or 210, whichever call spread I sell at. I could only lose one way. The credit that either I'm going to keep the full credit on the put side or I'm going to keep the full credit on the call side. Regardless, the max that I have to pay to close the trade will be $5, but I collected $1 from the put. I collected, let's say, $1.50 from the call. So I just reduced my max loss. But because I give myself so much downside protection, probabilities are on my side. And the reason why I was able to go so far is because the VIX was so high. The VIX is the index that tracks volatility. Because the market is crashing and dropping or free falling, VIX is going to be super high. So I'm able to go even further. When the SPY was trading at 338, for example, man, I miss those days already. If I sell if I sell a put spread, I won't be able to go as low as, I won't be able to give myself 40 points downside protection like I did with this trade here. If SPY's at 338 and market's doing well and volatility is low, my short put will probably be around 328, so only 10 points lower. So 328 over 338, I'm only 3% away from the current market price, and according to 100 years of data, 3% away puts me at, I've got an 84% chance of winning. All right, so this is 100 years of data. This includes the market crashes, includes the bull market, includes everything. But what if we go more specific? What if we just look at periods of crash or bear markets? So let's say we were to look at from 2007 to 2009 right here. So this is definitely this is similar to what we're going through right now. Just a free fall, right? So does this strategy work? And then we're going to look at 2000 to 2003, which was a 3-year bear market. So we're just 3 years where we're slowly going down. Okay, so let's start with 2007 to 2009. Just gonna put the same formula over here. So in the 2008-2009 crash, you could see that if we look at the SPY at a particular price, 30 days later, it has a 36% chance of being above it. So not the same as 64%, of course. But if you just look a little bit lower, if we look at 5% lower, so if we look at the SPY at a current price, 30 days later, it does not trade 5% lower. It does not trade lower than 5% of that current price. So you've got a 70% chance that the SPY 30 days later is trading either lower by 5% or higher. It's either trading in that range. If we go to 10%, we've got an 88% chance. That's based on 2007 to 2009 data. And right now, my put spread that I sold was about 12% lower, correct? So according to 2007-2009, it had a 91% chance of being a winner, meaning 30 days later, the SPY has a 91% chance of being above 195 in the case of my put spread. And once again, I don't have to wait till expiration. I don't have to wait the full 30 days because who knows? I could sell a put spread on day 1 and then on day 5, SPY goes up. I'm able to close my trade for 50% profit. But then after that, on day 30, it drops completely lower than my day 1 price. So I'm always I might have opportunities to make this trade profitable even if 30 days later the SPY is completely lower. So if we look at 2000-2003, which was the long bear market period, we've got a 41% chance that the SPY is trading above the current market price 30 days later. And if we look at 3% lower, we've got a 64% chance. So that's what's great about the put credit spread is you're already going to choose a strike that's lower than the current market price. So you're already going to be in these high probability trades, high probability ranges. And when the market is dropping, like in 2007 or in the 2000-2003 period, volatility is high. And when volatility is high, premiums are higher. So you're able to go even further. So you're going to be in these ranges anyways. But remember, this here covers 100 years. So it covers a lot of bull market. So that's why in this case, you get a 64% chance of being above the current market price 30 days later, while in 2007, you're only getting a 36% chance, and 2000-2003, you're getting a 41% chance of being above the current market price 30 days later. So let's look at this on a chart. It'll probably make more sense on a chart. So let's look at a 1 month period, which is 30 days. So this part here is probably not the best example because the market is tanking. So let's back up a bit. All right, so let's look over here. So I'm looking at this point over here, January 15. SPY is trading at 328. So I'm basically, the trade that I would make, regardless of where the SPY is I'm going to sell a put option lower, maybe let's say at 320. Because right now, 328, the market looks nice. It's a bull market. VIX is not high. There's not much volatility. So at 328, I would probably sell a put option at 320. So that represents, I want to see how much lower that is. So that's about 2.5% lower. Okay. So if my put strike is 2.5% lower based on the all data, 2.5% lower. So I've got about 80% chance of winning on that trade. I've got an 80% chance that 30 days later, the SPY is trading above 320 in this case here. Okay. So what happens? I sell it and then days go by. The the SPY moves up already. So probably around here at this point, I'm probably able to close it for 50%. Whatever I collected as a credit, I can probably close the trade for 50%. SPY is trading at 331. When I opened the trade, it was trading at 328. What happened is time passed by, time went by, and the stock moved up. So that gives me a chance to close my trade early. If it doesn't, what's going to happen is you could see that the next few days it dropped, it went to 323. Remember, my short strike is 320, so I'm still safe. Don't have to panic. But definitely I would not be able to close my trade yet. And then days go by, still would not be able to close it. It drops again to 321. I wouldn't be able to close it. I'm not in trouble yet. Getting close to it, but not in trouble. And then look at this over here. It goes up to 333. So definitely, if I was not able to close my trade here, I would definitely be able to close it here. I did not have to wait the full 30 days. But if I did wait the full 30 days, I would have kept the full credit. But because I don't know what's going to happen, you don't want to keep risk longer than you have to. If you have a chance to get out at 50% profit, you get out. So at this point here, I would definitely be able to close the trade early for 50%. And then we move on. Let's say I sell another one over here when we look at it 30 days later. So same thing. I'm at 331 right now. Probably would have sold a put spread at a 325 short strike. Okay, so 325 is my limit. I make money if 30 days later the SPY is trading above 325. And time goes by. We're still at 331. I would not have been able to close it for 50% yet. And then it drops, so that's not good. I would not have been able to close it. Remember I said my put spread, my put option is at 325. Right now it's at 323. The stock is trading at 323. So I've got a few choices. Either I do nothing because I still have a lot of time, or I start selling a call spread to help reduce the risk in case the SPY breaks lower than my 325 strike. Let's say I did nothing. I still hold on. It goes up again above my 325 strike. You could see the price on the right side, and then it goes even lower. January 31st to 321 goes much lower below my 325 strike. I could either sell my call spread, reduce my max loss at the same expiration, or do nothing. If I do nothing, I'm lucky because I get the chance to close the trade for 50% at this point because it's way above my short strike of 325. It's trading at this point at 334. Let's look at this example here. So this is where I got caught because SPY's at 338. I ended up selling a put spread at 328. So my put option is at 328. 30 days later, you could see that the SPY is at 240. Nowhere close, nowhere near 328. So that put spread got annihilated. But this was also a historical event. This is not what happens most of the time. But how could I have mitigated this is as soon as it drops below my 328 put option. So at this stage here, I start selling call spreads. So I sell a call spread at 328 if I want. It doesn't matter what. There's many ways to manage this. The approach will be different from person to person, but there is a way to reduce max loss. You don't have to accept max loss. So as soon as it drops below your put option, you start to take action. You sell call spreads with the same expiration and the same width between the spreads. So if my put spread is 328, 323, so I sell the 328 put option and I buy the 323, then my call spread, for example, I will sell the 328 call and buy the 333 call. So it has to be the same width of the strike so that I'm not adding extra risk on the trade with the same expiration, of course. So I sell a call spread, I collect a credit. Market is dropping fast, so VIX is going up, so premiums go up. So I'm actually collecting a nice credit and I still have a lot of time in my trade. And then it keeps going lower, keeps going lower. There's nothing I could do. That trade is going to become a loser, but at least I reduced max loss by a lot. But as it's going down, I'm selling a new put spread. Maybe, so as it's trading at 311, I'll sell a new put spread maybe at 290, and you get the idea. The market keeps tanking, but 30 days later, as you could see, if I sell something here February 26th, and let's say I pick a 290 put spread, it goes to 297, 296, then comes back up again to 309, 300, 312. So at this point here, I could have probably closed my put spread here that I sold at 290. But then at this point here, if I sell a new put spread March 4th, SPY's at 312. If I sell one at, let's say, 300, you could see that 302, 297, 274, 288. This one had no chance of surviving. All I could do is reduce max loss. But as the SPY is dropping, guess what? I'm going to sell a new one, a new put spread. So my existing put spreads in this case, in this historical scenario, my existing put spreads are dead. They're losers. But my new put spreads, have an even better chance of winning because I'm able to collect more premium and I'm able to go even further away from the current market price because volatility is higher. So in the example that I mentioned earlier, when the SPY was at 240, I sold a put option at 195. So I went as far as 195 and I was able to get out of this trade 4 days later because the SPY rallied a little bit. Now the SPY dropped again to 226. So we'll see Monday what happens. If it drops even lower, I'm going to sell a new put spread again 30 days later, but I might be able to go all the way down to 180 as a put option. I'll sell the 180 put option and buy the 175 put option. Collect maybe $1, risking $4, but I won't accept to lose $4 because if the SPY continues to drop, I'm going to sell a call spread to mitigate that loss and reduce max loss. So instead of losing $4, I could maybe lose $1, $1.50. Depends how soon I take action. Or I could even close the trade for a profit if SPY stays above 180 or rebounds a little bit a few days after opening the trade. So I'm choosing a 1 month period. I'm just going back randomly here. Let's go to December 2018. I think that would be a good, it's more realistic where you get a slight market correction. So here's December 2018. So you could see here that December 3rd, SPY was at 275, but 30 days later, it's at 252. So if you had applied this strategy of selling put spreads on the SPY, let's say 3 times a week. So at this point, when the SPY is at 275 or 279, when the SPY is at 279, your put spread is probably going to be around, let's say 270, maybe 271. So your put option that you're selling is at 271. So you only win if 30 days later, the SPY is trading above 271. So as you can see, 30 days later, it's at 252. So this one would become a loser for sure. But as it's dropping, you'd be selling a call spread to mitigate that loss. And as it's dropping, you're selling a new put spread as well with a fresh 30 days. So let's say over here, December 7th, SPY's at 263. You're going to sell another put option, let's say a put spread, let's say at 250, right? Because it's dropping, VIX is higher, so you're able to go even further away. So let's say you sell a put option at 250 and you buy the 245 put options. For you to make money on this trade, you need the SPY to stay above 250 in 30 days. Let's see what happens 30 days later. 30 days later, it's at 257. So this trade would become a winner. So even in December 2018, when we had a strong market correction, you would have been able to make money by selling put spreads. It's just you have to develop an approach where you don't get yourself in too much trouble, where you reduce max loss in case you are wrong, and you close the trade early for 50% profit when you get the chance. For example, I was selling put spreads. I was doing this strategy since January, and February I was doing pretty well. I posted my profits, and then I got greedy because they were about $1,000 US, $1,200 US per month by selling put spreads. So I said, I was doing 1 contract every Monday, Wednesday, Friday. So I decided to make it 3 contracts every Monday, Wednesday, Friday. So 3 contracts of $500. So that's $1,500 per trade 3 times a week. That's my max risk. Obviously, I'm collecting a credit to open this trade. And as soon as I started doing 3 contracts, guess what happens? The SPY decided to drop in the most historical fashion ever. So from 338 to 240 in 5 weeks, or 226 in 5 weeks. So as soon as I started adding contract, market decides to drop the hardest and fastest it has ever dropped. So it's important to respect your size, not to trade bigger than you can, because there will be moments where you're going to lose. These trades will become losers, so you have to be able to absorb the losses. If your account cannot absorb the losses, then you cannot trade bigger than a particular size. But the strategy, in my eyes, makes a lot of sense. I hope you could see what I see. Basically, it's probabilities based on 100 years of data. And it makes sense because the market wants to go up. The general direction of the stock market is up. The goal is to go up. There's people working hard, pushing the stocks to go up. There will be years or months where it'll crash, and that's where you have to learn how to mitigate that put spread strategy. But most in the long run, you'll have much more winning trades. And even when it's crashing, you're able, because volatility is higher when it crashes, you're able to go even further out, turning your put spread profitable. And if it's not, you have to sell that call spread to mitigate that loss. And you're not always going to be in this type of market. If you look at the past 5 years, these put spreads would have been really, really perfect in this strategy in this market over here. But then this over here really destroys it. But if you have the right approach to it, you can reduce max loss. You don't have to lose that much if you have the right approach. Let's go back a little bit further. So look at this here. So obviously from 2009 until now, the put spreads would have worked so well. These small periods here where it dropped a little bit, you were not going to lose enough because it was a very short period. So really the only dangerous period is 2008, 2009 when it drops in a straight line for a while as well. And obviously from 2000 to 2003 when it just gradually drops. But as we saw from the probabilities, even in 2000 to 2003, if you're selling a put option 5% lower than the current market price, you still have an edge. You still have a 76% chance of winning. So you have a higher chance of winning than losing. So to summarize, based on 100 years of data, you've got a 65% chance that if you look at the SPY on day one, 30 days later, it's trading at the same price or higher. That's based on 100 years of data. So what's the trade that allows you to take advantage of that edge, of that probability? It's the put credit spread, selling a put credit spread out of the money. So not exactly at the current market price, but selling it a little bit lower, because selling it a little bit lower gives you an even higher probability of winning. It gives room for the SPY to drop a little bit and you could still win. So you actually win if SPY stays put, if it moves up, or if it goes down a little bit, you're able to make money from this trade. And as for the rare occasions where the market crashes or we go through a bear market, you could still win with the right probabilities if you go further away and if you mitigate the losing trades, because you will have losing trades as soon as the market drops. At the beginning of the market crash, they will be losing put spreads, of course. So you have to mitigate it with call spreads. You might say, okay, so now we're crashing. Why not just sell call spreads then? Why not ignore the put spreads and just sell call spreads? Sell on the top side, because you don't know how long it's going to last, the call spreads. You don't know if the market's going to rebound and then blow through your call spread. Plus, you don't make as much from the put spread. You don't make as much from selling calls. The puts are worth more, and you're also able to go even further out with puts because there's more fear that the market crashes. So because there's more fear in puts, so the premiums on the puts are higher. All right, so I hope this wasn't too confusing. If you have any questions, leave in the comment section below. If you want to understand what a put credit spread is, I'll link a video below, and I'll also link a video from Option Alpha and Tasty Trade. They explain the concept pretty well. And of course, if you want to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.